Fitch's Fixed Interest podcast delivers the analyst insights and updates you need to stay ahead in a rapidly evolving market.
Thanks for joining us. I'm Terry Gallagher from Fitch Ratings Investor Outreach Group. Today we'll discuss the latest findings from Fitch's July U.S. and European distress and default monitors. I'm joined by Brendan Hoelmer and Leonie Dackham of the Fitch research team to answer some questions and offer their insights. Starting with the U.S., Brendan. First glance, both regions appear to be showing some improvement in trailing default rates. The U.S. leveraged loan and high-yield default rates fell to 3.8% and 2.7% respectively. Can we take that as a clear sign of market improvement?
On the high yield side, that 2.7%, that is right in line with historical rates. It's right in the middle of our forecast. So let's focus more on the loan side. That 3.8% trailing 12-month rate was a 70 basis point drop from the previous month, which is very, very large. The main point I want to emphasize here is that the drop is a little bit misleading. It's really the result of a base effect rather than an improvement in underlying credit quality. Last year, the June month of last year, we had $15 billion of loan defaults led by Altice France, and that's rolling out of the window. We've also had a relatively light summer of defaults this year, and that's kind of leads you to that rate drop. However, our market concern loans list tells the real story. Every month, our analysts comb through the investable market that we track. We use a composite of information, prices, ratings, news flow, our analyst views, etc., to categorize issuers based on the likelihood of default. And what we find here is that the combined lists are roughly 17% of the market, which is near an all-time high. And the top concern list, which tracks the issuers that we expect to default over the next 12, maybe 24 months, is at an all-time high of 8%. So the pipeline of default activity is building, even though the rate is appearing to improve. And for a lot of these issuers, we have pretty clear line of sight to defaults. Many of them have hired advisors, their loans or bonds, as the case may be, traded at very distressed levels. Just to touch real quick on a couple themes that we see, healthcare continues to be a big one. 3 of the 4 loan defaults were in that sector for the month. And of course, software and technology services continues to trade at distress levels, kind of at a sector level. Although our view is that the AI impact is perhaps a further out event for the issuers that we're tracking currently. So as we look into the second half of the year and a little bit further out, we expect that base effect that I mentioned to reverse. We expect the trailing 12-month rate to climb back into our 4.5% to 5% window. And then further out from that, the rate environment is kind of the big variable here. That'll be a big factor, I suppose, in portion of that 17% ends up ultimately defaulting, but has minimal impact on our sort of near-term 2026 and early 2027 default expectations.
All right, thanks, Brendan. All right, turning to Europe. Leonie, on the surface, we saw some similar results. European leveraged loan and high-yield default rates dropped to 2% and 2.1% respectively. What can you tell us that's behind the numbers? What's behind the headline?
In Europe, as you mentioned, the trailing 12-month default rates for both high-yield bonds and leveraged loans, they fell again last month. But the key thing here is while the backward-looking data has improved, our market concern list continued to signal rising forward-looking stress. The share of leveraged loan issuers on our market concern loan list rose to 11% in June, and this is actually the highest level since February 2013. About a third of issuers on the top loan list, and this represents nearly 7 billion euros of debt. They are in discussions with lenders or they have restructurings already underway. And a further third, this accounts for another maybe 8 billion, thought to have hired advisors. So together, this has led us to raise upward our 2026 European leveraged loan default forecast to 4 to 4.5% from 3 to 3.5%. But similarly to the US, we have left our European high yield forecast unchanged. The important thing to stress here, though, is that refinancing conditions do remain supportive for stronger issuers, but they have become more challenging for a subset of weaker loan borrowers. The important thing here is also that our CLO team have done some analysis on this, and this shows that the exposure to issuers remains low.
What about changes in the concern list, or were there any other observations you wanted to point out?
Yeah, so the main change that we made this month was that we escalated the theme park operator Motion Entertainments, also known as Merlin, to both the top loan and bond lists. And this was due to the news that the company has hired advisors to review options for refinancing its 2027 maturities. Another interesting thing is that unlike the US that Brendan has already mentioned, with sort of a convergence in some of those sectors, we are seeing sort of more idiosyncratic reasons here. But that being said, France continues to be the largest contributor, with 11 issuers accounting for nearly a third of the debt on our market concerned loan list and nearly 20% of debt on the market concerned bond list.
Thanks, Leonie, and thanks again, Brendan. Thanks for joining us. That concludes the roundup for this month. Please join us next month when we review the latest developments in the global leveraged loan and high yield markets. For more insights, please check out our research on fitchratings.com.
Subscribe to Fixed Interests wherever you get your podcasts.